Hey, thanks for joining me again today. We've got the big board, no small board. We've got the big board. We're looking at the personal finance Reddit today. We're gonna take a look at some of those questions, get a feel for how to handle your money a little bit. Let's get right into it. The first question we're looking at today, should we pay off our car or should we invest in a Roth IRA first? And we're gonna make the answer simple. As you can see, as always, there's a nice full question here from Reddit, but what we wanna boil this one specifically down to is the interest rate versus the return. Now, this is a simplified answer, but of course, we have to boil it down to really truly get information and be able to work with some of that information and turn it into actionable insights, right? So again, by making this simple, in this question, he's working with a 6.25% interest rate, and he can pay debt down on that interest rate, or he can invest it in a Roth IRA and try and generate a return that's gonna be higher than that 6.25%. Now in this example, as more of a conservative-minded person, but also I like a good solid 6.25% return, my advice is usually going to be here. Pay off that debt, get rid of this interest you're paying, because at the end of the day, what we're talking about is a guaranteed 6.25% return versus what you think you can get with your investment. Now, again, if we think that's gonna be 10, 12%, we're talking about a whole different question here. But if you can get that guaranteed 6+% return, never a bad bet to pay that debt down and get rid of that in your profile. Thanks for barking, dog. Second question we're looking at today, we're staying in the interest rate realm. We're looking at a car that's financed at 9% interest rate. This person in question wants to know if it makes sense essentially to refinance the loan. They're talking about a car payment. Let's look from a credit union to pay off that loan and essentially be financed at the new rate. Yeah, that's good. That's gonna work, right? You can always do that. I think the important thing to answer here is that yes, you have that option. You get to do that. We're talking about a refinance. Always want to look into that. Anytime interest rates are shifting, make sure you're keeping a good note of, especially with your home, your car, where are your loan rates for those particular, or your interest rates for those particular loans, and can you get a better one if you refinance? So it is something you want to be considering. Consistently look into it. If you can get a better rate, it's worth going through the process of refinancing your current loan. Third question we're looking at today, we're looking at a person who's financially illiterate. This comes from our Broccoli family. Help explain freelance income and taxes/reporting. Let's put number 3 on the board here. We're gonna keep it simple. We're talking, at the end of the day, estimated taxes, baby. And what you need to know about these is that if you aren't paying taxes through your W-2 job as an employee for a company, you're likely going to be in a spot where you should be thinking about paying estimated tax over the course of the year. What are they? The IRS essentially wants you to be paying your tax liability over the course of the year, hence your W-2 withholdings, or they want you to be doing that on your own, right? So the formula is yes, you're going to have essentially you're going to have a tax liability at the end of the year. That's represented here with our EOY. End of the year, you're gonna owe $100,000 in taxes. If that's the case, the IRS will expect that you have paid $25,000 at 4 different points during the course of the year. 1, 2, 3, 4, leading to that $100,000. Now, of course, it's not that simple. It's not always easy to forecast your income, so what does the IRS do? They give you some what they call safe harbor limits, meaning essentially, to keep it simple for this question, you can essentially pay 100 to 110% of your last year's tax liability, depending on how much money you're making. This is where it gets interesting, very confusing. But again, there's all these thresholds you're dealing with. Think 100 to 110% of last year's taxable income that you can pay over the course of 4 quarters to meet the estimated tax rules. Now, of course, this is something you need to be working with an accountant with if you're dealing with this at any kind of level, to make sure you understand and do this right so you don't overpay on your taxes here. But that's at the end of the day what we're doing. We need to forecast our year-end income and we need to pay that over 4 quarters as much as we can. Your accountant will help you find an easier way to do it, the simplest way to do it, but you do need to be paying those to avoid eventually additional taxes/penalties they're gonna impose on you. And the last question we're going to throw out there today, our 4th guy, we're going to throw him all the way up here in this corner. Hopefully you can follow along from there to there, but you're a smart viewer. This question deals with when is the capital gains going to be taxed at 20%? I'm gonna flip it up here as I'm talking to you. I'm gonna look it up. In 2025, the 20% capital gains rate starts at about $533,000 in income for a single filer. Meaning, if you, within their formula, if you get to $533,000 of AGI, adjusted gross income, you're gonna end up in the 20% capital gains tax bracket. Now, a couple more intricate ideas to consider here if you're trying to do these calculations on your own is essentially, what is this number right here made up of? Well, at the end of the day, there's gonna be ordinary income, your normal income, your W-2 income, your regular business income, plus your capital gains income. So there's a consideration here of what's going into that bucket and what can happen. Now, you can, ordinarily, there's a 0%, there's a 15%, and there's a 20% rate. And you can fall, some of your, typically some of your capital gain income will fall in the 0% bucket. If you make too much money, which in this case, again, if you're making $533,000, there's a real good chance you're gonna completely miss the 0% capital gains bucket based on how the formula works to calculate your capital gains rates. We don't have the exact formula here, but rest assured, once you're getting up to this level, you are thinking about missing that 0% rate, getting pushed into that 15 and 20% a little bit quicker. Now, to directly answer the question posed, this formula is definitely more complicated than the simple one they've posed within the question. I'll highlight it one more time here. But no, there's more that goes into it. It can seem very simple. When you look them up online, you're gonna see certain rates, but there is additional wrinkles to this calculation that you have to consider once you're flirting with these income thresholds. But really what's important for you, make sure you do your best to keep these gains long-term. Don't be selling assets too soon unless it's part of a very specific strategy that you understand how to harness and move forward with. Ultimate goal, make sure they're long-term gains. You can deal with this a lot easier than you can the ordinary income tax brackets. Thanks for joining me again for a little personal finance talk. We got messy on the big board again, but we answered some pretty good questions. We're gonna be dealing with this specific one again, so come back if you're interested in this topics. Let me know if there's anything you do wanna see commented on. I'll see you next time.